I like this diversification in this revenue stream because if I lose one or two or three or five tenants, it doesn't matter. It does not change my life. But in some of these single tenant facilities, you lose one person, it changes your life. And I'm just too big of a chicken to deal with that, I guess. So I like that revenue stream. I like fairly predictable expenses. And so now I'm like, wait a minute, if I make this place nicer than it was yesterday, I can appeal to your emotion. You're gonna be, this is your home. Like I just made it a lot nicer. It's a prettier, I've added to the amenities and now I capture your emotion. And what do I do when I capture your emotion? I can charge you more.
Can I tell you why you and I are on this show today?
I'd love to hear it. Sure, yeah.
We interviewed a lot of people. I've talked to a lot of people about a lot of different commercial real estate topics. I started getting some duplicates, started really researching what are people looking for on the internet. We dove deep into our YouTube analytics and we found the most searched thing in YouTube in the commercial real estate category is investing in multifamily real estate. So why is it that multifamily real estate investing is the most searched YouTube search in the commercial real estate space today?
Yeah, I can tell you what I think. Obviously I don't know for certain why that is, but I will tell you, I think it's because people can relate and understand multifamily. Most people have lived in an apartment building at some point in their life, so they kind of understand it. And when I look at the various asset classes, it tends to have I couldn't find a better risk return profile. So what makes it that, right? Everybody needs a place to live. It's hard for me to figure out how to make that go away. If it does, you and I don't need to worry about this podcast because we got much bigger problems. So it feels like something that you can't just innovate away. You got to have a place to live. And I like it now because there's some predictability. It's not linear, it's not direct, it's not perfect, but it's the more I can grow cash flow, the pretty good chance somebody's going to be willing to pay me more for that asset. So now how do I do that? Well, I do that with rents, right? So we got a lot of different people paying us rent from a lot of different places. Remember, I'm a CPA, lender by background. I like this diversification in this revenue stream. Like I get scared of what you do. Congrats, hats off to you for doing what you do. Because if I lose one or two or three or five tenants, it doesn't matter. It does not change my life. But in some of these single tenant facilities, you lose one person, it changes your life. And I'm just too big of a chicken to deal with that, I guess. So I like that revenue stream. I like fairly predictable expenses. And so now I'm like, wait a minute, if I make this place nicer than it was yesterday, I can appeal to your emotion. You're gonna be, this is your home. Like I just made it a lot nicer. It's a prettier, I added to the amenities and now I capture your emotion. And what do I do when I capture your emotion? I can charge you more. I add value.
You smile on the first of the month.
That's how I grow income. And so you can see it's really a risk mitigation thing. But at the same time, we figured out, and a lot of people have, how to just make a lot of money doing it. So when you couple those two things together, that's why I'm here. And that's probably why this is what I'll do for the rest of my life.
So let's talk volume. We will talk about the first time multifamily investor, but I want to talk about you for another few.
Okay.
What's your range in terms unit number you're buying today?
Yeah. So per property, I like anywhere from roughly 100 to 200. That's my sweet spot. When you get really big, you start competing with institutions and they have a completely different capital stack. And it's really hard to compete with that. When you get really small, it's a lot of work and you don't make nearly as much money because you're too small. So I like that 100 to 200 unit. We raise funds now. We used to syndicate. Now we raise the money in advance in a blind pool fund. So we come to the market with money already raised. So now we're not the little fish in the big pond. We're one of the bigger fish in the medium pond. You know what I'm saying? So it helps, it all kind of fits together. And that's why I love that space.
Do you do older product, newer product? I hear rumblings in the space about that.
Yeah, I'm curious what you hear, but I will tell you what happens. The life cycle of somebody sitting in my chair is you usually start off with the more value add stuff, older stuff. And what you're doing is you've got to make money. Earlier in your career, you've got to churn and make money. And you just have to prove. You have to prove your track record. You have to I mean, you're trying to make money. You're trying to support your family. So as you mature in the space, you kind of flip slowly to this concept called wealth creation. So you don't want to hold a really old asset a really long time, because nothing good happens to an old building when you hold it for a long time. You probably know that. So then now you start migrating toward newer, nicer properties, because now you can hold them longer. So now you can hold them, you can buy them, you can hold them, make them better, refinance them, and now you have an asset that you can hold, and you got no money in it, and you go and do it again. And you go and do it again. And now you're creating massive wealth instead of making money. Does that make sense?
Yes. It's less hamster wheel, more work with your brain instead of your back.
Yeah, there you go. Yep.
But say I'm not a seasoned investor like yourself.
Okay.
I'm a first-time multifamily enthusiast. With your knowledge, what am I doing today to get my first deal done? And what does that deal look like?
Yeah, so it's going to depend on how much money you have, it really does. You really do need to look at your personal situation. Most people that get into our business, we have a whole education side of our business. So I know the answer to this question very, very well. So usually people come in just like I did. They had no real money. And so they're going to partner up. First thing you got to do is learn the business. You've got to understand numbers. So no matter what, if you don't take the time to learn the numbers, you will get burnt in this business. So learn the numbers. Get mentored by somebody who's been there, done that, because you can, I didn't have anybody back then. It took me a long time to learn some of the dopiest things that now I just take for granted. So learn, and then you're going to go after a deal that doesn't freak you out, doesn't stress you out. You'll probably raise a little bit of money. It'll probably be in the 30 to 50 unit range, maybe even a little bit smaller, but the capital raise will only be a couple $1 million. Maybe 3 or 4, right? But remember, if you've never raised capital, it's hard. And if you've never done this business, who in their right mind is going to give you their money to practice with, right? They won't. So that's why you need to really kind of start small in that 30-ish range, and then just go from there. What happens is, as soon as we get somebody their first deal, their whole life changes. Brokers take them seriously. Other investors take them seriously. Their family takes them seriously. It's really interesting watching it happen. So that's why I want people to start there. I mean, if you have a ton of money, go ahead and start bigger. But the reality of it is, if you're big and you need to raise money, the investors won't even give you the deal. They'll be like, yeah, whatever, thanks. And they'll just use you to leverage the guy that's going to really buy the building to make him pay more.
Why did you decide to go the fund route instead of the syndication route?
Yeah, so we did both. So initially, most people when they start raising money, they'll go find the deal. Then you got about 45 to 60 days to raise the money. Massively, you know the drill. Very stressful, right? Well, now remember, I said we buy in Florida. Florida is extremely competitive. So when we would go after a deal, we're one of 20, 30, 40 offers. So how are you going to differentiate yourself? I promise you, Mr. Broker, we'll raise the money. I promise. That's what everybody is saying. It's like, whatever, right? Yeah. So how do I make them take a chance on me? I have to pay up. So I got tired of that, right? So after a while, I said, what if I just, I understood the private equity model, because when I was at Deloitte, I did a ton of private equity work. Go raise the money. And now you show up with money in the bank. All of a sudden, everything changes. You no longer have to pay up to differentiate yourself, because now you got that certainty of close thing. They know you don't have to raise the money. They know you can close quickly. They know that distressed seller can count on you to get the deal done. So everything changes. So that's why it was out of necessity. Actually, we made money with syndications. I'm not saying we didn't, but boy, is it easier to get a deal now. We want a deal. It's a lot easier, because when you got 10 or $15 million in the bank, people listen. They just do. That's the way it is.
This is just a totally random anecdote. I have a theory that the wealthier the buyer and or the higher the value of the transaction, the lower the threshold is for the financial due diligence. Like if it's somebody who's highfalutin or high, it's like an article is sufficient for proof of funds. Whereas if it's $1 million deal, they want your P&L for the last 3 years. Anyway, that's a
Yeah, no, you're not wrong about that. You're not wrong. I mean, now I think they run soft credit checks on me, but nobody runs a full credit report on me anymore. On my very first deal, I guarantee you they did, because they're just trying to figure you out, right? See, after 20 deals, they kind of know who we are now. They just know. And the brokers, we're in that market all the time. All the brokers know who we are. You know, it's trust. Remember, brokers only get paid when you close. That's what they care about. Don't screw up the deal. Don't retrade their seller, and close so they get paid. That's what they care about.
Be good to your brokers, folks.
Mm-hmm.
And they'll be good to you.
They will. That's true.
Florida is an interesting place.
It is.
Where I know it's highly competitive, but you also have some issues. And I don't know where in Florida you own right now.
All over the place.
Okay.
I'm curious to your issues. I'm dying to hear what issues Florida has.
Insurance.
Oh, yeah, that's okay. Yeah. You just budget for it. So what happens, right, when you're in the business, right? Everybody that's successful in business knows all the little details that matter. Like, they really dive in, and we do the same. So I've been doing this 30 years. I know what insurance is going to do. It's going to cycle. It is what it is. So when insurance companies take losses, they jump out of the market. That makes the supply, the capacity, they call it, the cool people call it capacity, it goes down. When there's nobody there, there's no supply, the prices go way up.
Sure.
And here they go. Everybody jumps back in because now the business is insanely profitable. And now the capacity opens up again. So you just got to know where you're at in that insurance cycle so that you can budget for it the right way. Does that make sense?
Yes. That's fascinating.
You just know the market. You see what happens? You just know your business.
Mm-hmm.
It's literally that simple.
All right. That's cool. You know, everybody is losing their mind here in Colorado about taxes and insurance. When I tell you, I talk to owners every single day, multiple times a day, about how these prices are going haywire. But nobody has ever said what you said about insurance being cyclical. And so it'll be a vantage point. It actually makes sense what you're saying in terms of supply and demand.
It's greed, right? When they think they get a lot of money, they come back in. Now, what's going to happen? When the capacity grows, prices went down. Prices in the last year, you would be shocked to hear this, they're down 40%. 40%. That's a massive reduction. Massive, right? So now what's going to happen? Eventually, they're going to start taking losses.
Sure.
And the whole thing starts all over again. And you just got to know where you're at. But now, how do you protect yourself against that, right? That's what's driving your owners nuts. So this is now you got to go back to being disciplined when you buy. We don't buy something unless we are really certain there's $200 to $300 in upside. Why? Because what solves all the problems? More cash flow. This is the way it works. So, all right, yeah, insurance sucks, but guess what? If I have a 100-unit building and I raise rents $300, which is not uncommon for us to do, that's $30,000 a month, $360,000 a year. That's a lot of insurance.
Yeah.
You agree? So then when the insurance goes down, which it will, it turns now into profit.
Okay, I'll be able to sleep a little better tonight for that explanation.
Yeah, they'll be okay. They'll be okay. It's just people that are getting beat up right now are the ones that they bought and they maybe didn't execute as well as they had hoped, or they didn't really understand that you got to really go crazy. See, everybody in 2021, 22 was buying everything in sight, and they thought they had $300, $400, $500, $600 in upside, but they ended up with 100 or 150 because they didn't do the homework right. They didn't really understand the market. The property management company didn't execute for them. You know, a myriad of reasons. So now interest rates went up, insurance rates went up, and they got no new income to cover it. So they're toast. That's what's hurting people right now.
You know, we do hear of first-time syndicators jumping in 2021, 2022, and the story is not good thereafter from the folks who bought incorrectly.
Right. I mean, look, it's tough. I have to defend them for a minute. Even if they tried to do everything right, it is very, very hard to protect against a 500 basis point increase in interest rates. I mean, you can't protect against that. You've just got to hope that you put longer term debt on it, which most people didn't do. And then you got to hope that you got a lot more income and then a patient lender. That's why people right now, I mean, you hear the administration talking about firing the Fed chief. They want interest rates down. Remember, the guy in the White House at the moment is a real estate guy.
Yeah.
And doesn't matter if you like him or hate him, that's irrelevant. He's a real estate guy. He knows lower rates are better for the business. And that's now what you're going to see everybody paying attention to. Because right now, if we get a 50 basis point, maybe 75 drop in the treasuries, everything changes in real estate. Everything. Because everybody can get out of their problems right then.
Wow. Yeah, I have a few friends with a few problems right now. But
everybody does. Everybody does. Yeah.
Yeah. Hey.
But that's all it takes. It's really 50 to 75 basis points. That's it. When you look at it that way, it's like, well, that's not very much. And it's not. And I know that because when the treasuries hit back in September of 24, Treasury 70, I like the 7-year, it hit 3.5. The broker BOV request went through the roof. They're like, holy Jesus, what just happened? 2 weeks later, what happened? It disconnected, right? The Fed lowered, the Treasury went down, and then it disconnected because of some inflation reports. And then all of a sudden, whammo, all those BOV requests were withdrawn because it went up to 4. It's just 50 basis points, shut everything down.
Every day I am humbled by this business because it is the Wild West.
It's kind of fun. I mean, it's after a while, it is fun. It is fun to watch. I'm telling you, 50 basis points, you and I do this again in a year, we're having a different conversation.
I have no doubt we are. I really feel like I was talking to a broker this week. I said, how you doing? He said, better than I was 30 days ago.
Mm-hmm. Yeah.
And I have felt a big change in the last 30 days with sentiments. It looks like buying season, I think, is coming. And we should do this podcast in a year from now and see what in the world
we'll have
is
to
going
play
on.
excerpts from this one and then respond. And we'll see how wrong I've been. I probably, you never.
I
We'll
don't
see.
think you'd be the one who was wrong. Ken, you're clearly a wealth of knowledge. What's your commercial real estate secret?
It's discipline. You've got to I've been through 08. I've been through all kinds of cycles. I haven't been through everything. But the number one thing that kills people is they lose their discipline. And you know what happens when you lose your discipline? You get this fatal disease. It's called FOMO.
Okay.
And when you get FOMO, it is worse than COVID. It is worse than cancer. You're done. You're done. It is not curable. Once you're in it, you're done. So that's why I want people. That's the secret. You've got to stay disciplined. Ignore all the other, oh my gosh, I got a deal and I got a deal. That's what they were doing in 21. Just ignore them. Don't worry about it. You do the deal that you know is good and don't get FOMO. Stay disciplined and you'll be fine in this business.
Fundamentals, not FOMO.
I like that. I like that. I think you just came up with that, didn't you?
I did. We're going to need to put it on a hat sometime.
I think you are. Fundamentals, not FOMO. I use don't negotiate your discipline, but I like fundamentals or FOMO. I like that. That's even better.
Hey.
I'll let it's yours, though. I won't take it.
Okay. You can borrow it. Don't worry. Ken, for the listeners who want to find you, follow you, learn more about you, where can they do so?
Yeah, just go to our website, kripartners.com. And when you get there, you're going to find out that we teach people how to do what we do. Or if you don't want to do it, you're going to invest passively. What matters is we're trying to help you create wealth through real estate. So just go to kripartners.com and our team will make sure they take good care of you.
That's kripartners.com. Ken G, thank you so much for being on the show today. And for everybody listening, we'll see you next week.